Conversations, which is a product of our Africa Credit Expo. If you joined us during the Expo, which held in November last year, can I see I was there in the comment box. Were you there? If you were there during the November Expo, the first of its kind, I was there. Great, thank you. So this webinar is the first of the series that we held this year. We have industry experts. We have our speakers and our panelists that will be facilitating workshops and panel sessions, which are designed to empower us with the information that we need to make well-informed financial decisions that are relating to our credit debt management, payment plans, blockchain, and AI. So we have a lot in store for you. So we'll move on to the house rules. So this webinar will be recorded. All participants will be muted to allow the speakers to present without interruption. Our recording will be made available on our YouTube channel. If you have questions during the course of the presentation, please use the chat box. If you lose your internet, you can reconnect using the link that was sent to you, and then the webinar will last approximately 2 hours. So what's our agenda for today? The very first workshop will be good debt versus bad debt, what you need to know. And then we'll move on to the first panel session, which is enhancing the credit industry with blockchain and AI, the value of digital money lending, and the improvement of consumer credit in the Nigerian economy. And then we'll move on to the second workshop, which is the ultimate guide to payment plans, smart spending of financial trap. And then the very final panel session, which is I want to be a millionaire. Do I need a smart score? So I believe you do not want to miss any of these segments. If your friends, your colleagues, they are not here yet, do well to send them the joining link so that they are a part of what is about to go down. So moving on very quickly, we'll be introducing the very first, we're starting off with the first workshop, which is good debt versus bad debt, what you need to know. And what are we going to learn? We're going to learn the trade-offs between credits and other types of financing, when credit is bad or inappropriate for a business, how to apply the same principles to personal finance. And by the end of this workshop, you'll be able to understand how lenders make credit decisions, identify red flags that can hurt your credit score, and use that to your advantage to achieve your financial goals. So we have our A-list moderator that's ready to do justice along with our speaker. And so I'm going to be introducing the moderator who is going to take us to this session, and is none other than Chibuike Anomudu, our sales support officer, who is a sales and client relationship manager, in credit registry, and he's a multi-talented and results-driven professional. And as an effective executive, he has helped lots of fintechs to implement a data strategy. So without further ado, can we warmly welcome the moderator for this session, Chibuike Anomudu. Thank you.
Thank you very much, Chidema. Good day, ladies and gentlemen. I'm happy to be here, and I hope we are happy as well. Without further ado, I'll be ushering you into our first workshop for the day. Let me on the video. So in this workshop, we'll be co-learning with Madam Ojo on good debt versus bad debt. So Madam Ojo is a partner at Sahel Capital and massive contributions to different investment committees, managing huge portfolios and supporting startups through seed funding. She is a CFA charter holder and alumni of Oxford Said Business School, UK, where she had her MBA. Through this topic, she will be enlightening us on how lenders make credit decisions, identify the red flags that could hurt your credit score, and learn how to leverage debt in achieving our financial goals. Ladies and gentlemen, please welcome Madam Tosin by hitting your love emojis as I try to hand over the mic to her. If you have any questions in the course of our presentation, please feel free to drop them in the chat box. We attend to all questions after her presentation. Madam Tosin, please, you have the floor. Go ahead. Thank you.
Thank you very much, Ibukwe. Thank you very much, Idima, as well. Just to be sure everyone can hear me, can you all hear me clearly?
Yes, we can.
Okay, fantastic.
Yes, I can hear you, Madam Tosin. I can
All right.
hear you.
So thanks everyone again. I'm happy to be here, and to discuss this. I think this platform is a good one to just let people know about credit and different things that people should know, especially entrepreneurs, and see how they can better use credit to improve their businesses, or how people can better use credit to improve their personal lives. I'm going to share my screen, if that's fine, to just walk through the presentation. Starting from the topic, the first thing to note is debt is really what you make of it. So that can be good or it can be bad. So first and foremost, there's a general notion that debt is bad, that credit is bad. So a lot of people, and I think in this part of the world, because we do not really have a credit culture, we're a cash-based economy. So a lot of people are afraid about credit. A lot of people are afraid about debt. So I think what this topic first and foremost is saying is there's good and there's bad. And so I guess what we want to examine in this conversation is what would make debt good or what makes it bad. And what that means fundamentally is that on its own, it's not good, it's not bad, but after certain considerations, then it can be good or it can be bad. And the first thing I would say is that what makes credit good or bad, starting in a generic sense, is what you use it for, right? That's the first thing. Before I go into the details of this slide, looking at how businesses fund their operations, the first thing is to note, and this applies to either businesses or it also applies to individuals. The first thing to know is that what really determines whether is good or bad debt, the first thing is what are you using it for? What do you use it for? That's the first thing. Whether in your personal life or as a company. Now, later in the presentation, we're going to touch a little bit on personal credit, personal finance. But at the beginning of this presentation, we're looking at credit from a business point of view. Generally speaking, when you want to start a business, you are either using your own funds or you borrow, quote and unquote, borrow money from people, or you're using funds from people who are close to you. They could be your family, they could be friends. They are close to you and they sort of like invest in that business. And they say, you know what, we should give you this money, use it, invest it in what you're doing. They could give it to you as a loan, pay us back. It could be a soft loan, pay us back whenever you can pay. Or it could be, you know what, give us a stake in the business. Or you know what, it could be just sort of like donation, quote and unquote dash. Now, if you go down, you see on this slide, you see from what I've explained in very simple terms, shows what the general sources of funding or general sources of capital is for any business. It could be a loan from a friend, it could be a loan from a family member. That's debt. Even if it's 0% or if it's low interest rate, it's still debt because why? There's a repayment obligation you have to pay back. It could be we give you the money, you give us a stake in the business, we'll be co-owners of the business with you. That's equity. And it could be, well, we are just giving you this money to support you. That's grant. In the simplistic sense, that's what these things are. Mezzanine is when you kind of try to blend two of these things together. That's like really what mezzanine is. Now,
Okay.
when you start a business, what do you use the money that you raise to do? As you start a business, you're using it to buy the assets that you need to operate. Some of these assets are like long-term in nature. We call them fixed assets. And it could be machineries, it could be buildings, some of them are long-term in nature, but they are not fixed, tangible assets. They are intangible assets, like software. You get to use them for like many years. And some of them is like you need to buy the things you will use, regularly in the business, right? That you will use it within 1 month, 2 months to produce what you need to produce. If it's a food business, you need to buy food raw materials, for example, to produce what you need to produce. So those are what we call current assets. The money you get, whether someone loans you the money, whether an institution loans you the money, or whether gives you the money like a grant, this is what you use it to do. You use it to fund the assets that will produce the economic value in that business. So what we're saying up is that your business assets, you either fund them by equity, generally speaking, or by debt. This is the first thing to know, because if you don't know this, then you don't know what is appropriate to what and when. And that's why this is the starting point. Now, what are the implications of the different types of funding that you may get? I'm not going to spend too much time on this, but the general implication is that if it's equity funding, now a lot of people used to think that if it's equity, because you're not paying interest, it means it's cheaper than debt. Well, no, it's not. What is essentially happening is that you are working for, quote unquote, that investor, because the upside that you are working for in that business, you are giving that an investor a portion of that upside because you're giving a stake of your company out, right? So you are working for an upside. You're working for the upside, right? However, there is no immediate claim on your cash flow. So that's the good thing, because it's not, you will not be paying interest, right? There's no obligation to pay interest on equity. So in the short term, in the immediate term, you are not paying out cash as interest. So it gives you time to compound the effect of your cash, of the cash in your business, to put it back to work for it to grow and develop upside. However, it is not dash money. That investor owns a part of that business. And once that upside is created, it's going to get a proportionate component of that upside, right? A component that is proportionate to the stake they own in that business on that upside. It's also higher risk because you're not paying interest in the, you're not paying cash out, you're not paying cash out as interest in the interim. What it means is that the investor is not getting anything, and if there's a downside, you share in the downside together. On the other hand, debt, you are paying back. First, you're paying it back. You're paying back immediate cash flows as interest. That's the biggest difference, right? In many cases, if it is, I've used a very simplistic example at the beginning, but in reality, let's say you go to an institution and you get debt. They will look at your financial statements, they will look at your operations, they will examine a lot of things, and they'll put a lot of restriction around what you can do. For example, with a bank, the monies you receive from your business have to be collected in the bank. They put a lot of ratio. In one of the slides, we're going to look at a few of them. This ratio cannot exceed this ratio cannot exceed that. They put a lot of those things. You are restricted. They monitor very closely how you spend that money to make sure that the interest that they require, you are able to pay it, and they have seniority claim. Debt is not interested in whatever upside your business wants to do. They are just interested in pay me the interest and have the ability to pay me back my money. Now, so when you use debt, like I said from the beginning, what makes debt good or bad is how you use it, what you use it for, when you take it, when you use it. So how should you use debt? Generally speaking, when you are in business, the businesses go through like 3 to 4, business cycles, and this could be over the lifetime of a business, or it could be they could go through this in many cycles within the life of that business, right? So this can happen in many cycles, right? Or this can just be over a long time, over a long period in that business. So at the beginning, what we call early stage, the businesses that we call startups, you have idea, you have built the idea to a minimum product, you are about to start generating sales, you are beginning to onboard customer. This early stage, you move from anywhere between when you have no sales, you still have an idea, you move from idea to product, you've developed the idea into a product, or a service, and then you start onboarding customers. So this first stage, you move from no sale to low sales. In a business, your cash comes from your sales. You could, except where people give you grants, or where people invest in your business, the sustainable flow of cash into a business comes from the sales, right? Then you move to a phase where we call growth phase, where people have tested these products, it's working, they've given you feedback, you are fine-tuning the product, it's meeting the needs, there's customer referral, you are growing. That's growth phase. Then you can get to the point where you're still growing, but the rate of 50% month on month in your revenue or in your sales, at the maturity phase, you may slow down to 10%, right? And eventually it gets to the point where it's even almost flat, where if you're able, at the peak of this graph, if you're doing 10% before, you're able to do 1%, 2%, it slows down, because at the end of the day, the size of this business towards the later part of this graph, for example, is much more bigger. And when you are a much more bigger business, the rate of growth slows down. Now, many businesses can stay stable, and if they're not careful, a new competition comes, and they start declining, right? And every business go through this. Every business will go through it. That's why today we have some businesses that are existing today, they were not existing 20 years ago. We have some businesses that were existing 20 years ago, they are no longer, innovation, competition, different things to come. Over the life of this business, the different phases of this business is appropriate for different types of funding. Now, on this next slide, I have sort of like superimposed like what types of funding should you use at the different stage. Like I said at the beginning, the very first reason why a credit turns bad or people run into problem is that they have used it inappropriately. The first, when you start and you're at early stage, when you have no sales or low sales, you should not be using debt. In fact, you see here that equity is not even really at that first stage, because it's very hard to convince someone to invest for a future upside in something that is just an idea. I mean, that person must really, really believe in you, or they just trust you. Maybe there's an emotional tie, maybe family, friend, something like that. Otherwise, it is very difficult for someone to believe in an idea that you have, or in a product that you have just developed and you have not generated any sale, for the possibility of a future upside. That's too much risk. Now, the most appropriate funding are that. So if equity is not appropriate, debt is completely not appropriate. Now, if you see a lot of people at early stage, they are taking debt to fund the business. They say because the debt is cheap. And I'm going to emphasize here, even if debt is cheap, it is inappropriate at the early stage of a business. Even if it is cheap, it is inappropriate at the early stage of a business, right? Because by nature, debt is low risk. It is about your cash flows and downside protection. At that stage, you don't even know where cash flows will come from. So at that stage, grants most appropriate. As you start growing, it becomes easier to convince an investor to make an investor see the upside potential of that business. Now, in this growing phase, doesn't mean you're profitable yet, or maybe your profitability is still very low. But the investor can already see that you have track, that you are growing. So early stage, no products. Early stage is idea to products to low sales, like you've onboarded a few customers. Growth, you now have a growing customer base. Maybe last month you onboarded 100, this month you've onboarded 120, and then it moves to 150, and they can see that customer base is growing, they can see that the revenue is growing. Then it becomes easier to convince an investor to say, okay, invest in this business, right? And there will be an upside in the future. Equity becomes appropriate. At this second phase, debt is still very inappropriate. Because even though you are growing, you do not have profit. And if you don't have profit, you have no cash flows. There's a saying that says revenue is vanity, profit is sanity, but cash is king. There's a variant of it that says cash is reality. You can be making sales. If you're not generating profit yet, you do not have cash. You do not have cash flow. If you don't have positive operating cash flow, positive cash flows, you cannot service debt. And therefore, even though you now have a business that is growing, that is still inappropriate. In Nigeria, what we see a lot is that at this growth phase, a lot of people take debt. Because two things, people don't like to give equity in their business. Why would I? I've done so much. How will I give equity in the business? Second part, there's in some sectors that are relatively cheap debt, and because of the allure of the cheap debt, some people can take debt. The third thing also is that apart from the cheap debt, in fact, not even cheap, there are some people that even take very expensive debt at this growth phase. Now, you see the monthly interest rates of 10%, and you're wondering, how will you ever survive, right? One other thing that I also need to mention is that at this growth phase, you're investing in assets that will generate the long-term growth, which is the reason why, which is also what makes debt inappropriate. Because if you are buying a machinery, before you bring the machinery, before you install, before the machine starts producing, your interest service is due. You need to have servicing interest because you're investing in assets that produce long-term growth, right? You don't have the cash flows immediately to start servicing debt. Now, when you start getting to maturity stage, and when I say maturity stage, I'm not talking about, if you look at this chart, you see that there's still growth. But what is important at this phase is that the growth is now predictable. The business, so people can fear what your next year revenue is going to be with a relatively high degree of accuracy, and you're making profit. You're generating cash flows, and then you can service debt. This is the first thing, incredibly important. This is not about sentiment, somebody is offering me debt, somebody is chasing me. This is about what is appropriate at the stage of my business. Now, just to emphasize this, there's this report, I'm going to touch on a bit on this. One of the major reasons why business fail is just because there's a misfit between the funding they've received and what they've used the funding to do. Some are taking funding that is supposed to be for short term, they've got to tie it down in long-term assets. When it's time to pay back, they can't pay because long-term assets are not so liquid to sell. Some have taken funding that is appropriate for long term, they've tied it down into short term, they've used it for short term, therefore they cannot generate the upside for the long term. One of the reasons why business fail is because we call it poor cash flow management. And what really leads to poor cash flow management is a broken capital structure. When you have taken the inappropriate capital for an inappropriate business activity. That's what really leads to broken capital structure. Now, a few things that people should pay attention to if you're going to business, we are going to take debt. I've explained when you should take debt, and a lot of people. I mean, this is difficult for a lot of people because, like I said, a lot of businesses in growth phase in Nigeria, they like to take debt. When they now come for equity, when we see them, the capital structure is a mess. Now they now want you to use the equity to pay down the debt. It should be the other way. Equity should come in first to take the highest risk, and then you go and take debt later when the equity has produced the cash flow to service the debt. But a few things to pay attention to. Like I mentioned, debt is always about cash. That is always about, can you service interest? Can you generate enough cash? So if you look at most of the ratios we have here, it's really around the cash, interest coverage ratio. Can you, by how much can your profit pay the interest? That's what that is essentially. If your profit, we call this warning sign. If your profit cannot service the interest expense by more than 1.5 times, real profit, not the EBITDA is what we call real profit, not to a large extent you're taking out accruals. If you cannot service, if that profit cannot pay the interest that you're going to pay, either on a monthly basis or quarterly basis, whatever period you're looking at, by more than 1.5 times, you should really think twice before taking the debt, right? Some of these things are quite technical. I think if you're going to take debt, you should spend a bit of time with your banker or spend a bit of time by yourself to understand some of these things, right? Profit is not cash. Like I said, profit is sanity, but cash is reality. So even if your EBITDA which is profit, can pay the interest by more than 1.5 times, you still need to go and look at your cash, because there's a relationship that will take that profit to cash. So you need to go and look at the cash you're generating, and that cannot be less than 1. That's what we call the cash coverage ratio. If your operating cash cannot service the interest, if it is less than 1, then red flag, you're running into problem. And this is based on what you are doing currently, based on what your performance is now, not some projection of what will happen in the future. Because like I said, that is low risk. If based on where you are right now, you cannot meet all of these things, there's no point hoping that you will generate the revenue or the cash to get to that point. Now, a little bit of this action, you can take questions. What I've explained for a business applies also to individuals. Now, in business, we talk about equity, we talk about balance sheet, we talk about your assets. For an individual, we talk about your net worth, which is if we take everything you have, or value, and we deduct everything you owe, what is left is your net worth, right? Everything you have is, and I'm talking about tangible things. Well, I'm talking about quantifiable things. Everything you have, your pension, everything you have, if you have investments, if you have saving money in your savings account, if you have a car, if you have a house or a home, everything you have, if you have valuable art, if you have valuable jewelry like gold, everything you have that is of value, when we take them and we deduct everything you owe, right? So basically everything you own minus everything you owe. Everything you owe, if you have debt, mortgage on the house, for example, if you buy the car by a loan, the loan on the car, whatever debt you have, then that gives your net worth. Similar to the principle of business finance, you should be taking debt for things that are able to generate value, even on a personal basis. So you can take, for example, as a rule, especially in developed countries, people take debt for mortgage because it's an asset. Value will accrue over time as you pay down your debt, and the equity in the home increases. That's what you should be taking debt for. You should avoid taking debt for depreciating assets and actually avoid taking debt for liabilities. So, for example, consumption. So people, now if you're using debt in your personal life for consumption, that's a bad credit habit, which you need to correct. But if you take debt to, for example, buy a house, or if you take debt to invest in your education, that's something that can create value for you, higher earnings value in the future, that you can use debt for things like that. But if you use debt for consumption, that's bad, generally speaking. In this part of the world, we don't have a strong credit culture, so it really doesn't even apply to us like that. If you taking debt to buy a car, for example, where does that fall? Well, it's really a question of, some people will say debt, car is not an asset. Car is an asset, it's a depreciating asset. but an asset still. The point is, you should look at your cash flows in very, very objectively and think about how those cash flows can service paying the debt, paying the interest expense on the debt if you use it to buy a car, factoring in the fact that the value of that car will depreciate. So if it's for your personal comfort, then it must mean that your personal comfort and the value of that personal comfort and the time that you will be able to have and what you use that time to do is able to generate value that compensates for the expense you are incurring, additional expenses that you're incurring on that debt. Or it could mean also that you take it and use it to do business. Maybe you take the car and you can use it to do Uber. Right? And even though it's depreciating, it's generating cash flows that is able to pay back, offset part of the debt. But like I've said, even in personal life, what makes debt good or bad is what you use it for. Another thing that makes debt good or bad is how leverage, I should have mentioned that also in business finance, how leverage you already have. As it is with everything, of course, a good leverage, there are ratios they look at. If, for example, if you're taking personal loans, there's something they call, I think, your loan to value, your installment payment ratio, something like that. So how much are you going to be paying back instrumentally versus your income, what you're getting? If it's more than 30%, you can't afford the loan. If it's more than a third, you can't afford the loan. So that's the financial institution, a good financial institution takes care of that. If a financial institution is giving you debt when you're already super leveraged, then it's bad debt from day one because they don't know what they're doing. But where there's a bit of issue, mismatch, is that people take debt with the right intention, they want to pay back, but what they've put the debt into makes it very hard for them to pay it back, and therefore debt goes bad. So I think that's where I'm going to end this presentation. And then maybe we can take questions, and those questions can help us shed more light into any area that anyone needs more explanation on or would like to clarify for that. Thank you very much, everyone.
Awesome. Thank you so much, Madam Tosin, for that impactful presentation. So everyone, we've just had a thought-provoking presentation on the concept of good and bad debt. The speaker enlightened us on the concept of debt financing being a viable source of funding for businesses depending on the stage and nature of your business. So we are now in the question and answer session, and I have a question from the chat box. So the first question is it advisable to take credit in Nigeria to start a business, considering the prevailing economic situation? Madam Tosin, did you get that?
Yes, that's one of the things I explained. It's not even about prevailing economic situation, and it is not about Nigeria. Debt to start a business is a bad idea. Because like I said, when you're starting a business, that business is at the highest level of risk. You've not done that business before. You don't have a customer. You don't know whether it will succeed or it will fail. You need to develop the product or develop the service, hire people, find customers, make your first sale. Debt is bad to start a business. If you want to start a business, you start a business from your savings, find partners that can invest in the business as equity, find friends and family that believe in you and can invest money in that business. Debt is not the appropriate funding when you are just starting a business.
Okay, thank you. Thank you very much. I think you also mentioned something around this, but I think this person wants further clarification on it. So she said, is it advisable to take a loan to pay for schools abroad, considering the outcome?
This is a very, very important and quite tricky question. Like personally, I took a student loan to go to Oxford. Most of the top schools are expensive. Most times, what you take to pay for those schools is similar to what you're taking for a mortgage that you're going to pay back in 30 years. So the first thing I say to people is that be very thoughtful about why you want to go to school abroad. What is it that you really want to achieve by it? Don't make it an emotional decision or a very a very, haphazard decision. People are going to schools abroad, let me to go to school abroad. You don't need a degree from abroad to get a good job, to excel at the job, and to be paid well. Many of the top CEOs of many of the institutions in Nigeria, many of the top senior people in many of the institutions in Nigeria, they don't have foreign degrees, right? What people pay for is expertise, execution, and your ability to deliver. So you have to be very thoughtful about, why do you need this degree? Now, if you have done that analysis and you feel like, okay, I need this degree because I want to work in a particular industry or in a particular sector, and I need this degree to break into that sector. If I work in that industry or sector, it will increase my earnings potential by X amount. You need to do all these analysis. You will get some of this data. So, for example, you're trying to break into, let's say, tech sector. And you know that if I go to a certain school, it increases my ability to be hired in tech, for example, and I'll get paid this average income. You do that analysis. And if you think, and after you've done that, you're like, okay, if I'm paid this income when I go, right? I'll be able to pay off the debt maybe within 5 years, something like that. Then you've been very analytical, and now you've approached it, right? So it's a long answer to a short question because it's not a yes or no. Like I said, investing in education is good because it has long-term earnings potential. But you have to be thoughtful about it because it's not an automatic blanket check. No matter the school you go, you still need to, a degree is what you make of it. You don't, it's not really about you've collected the degree, it's really what you make of it. So you need to be very thoughtful about what you want to do and how you go about it after you've gotten that degree to justify why you are incurring that debt to go to school.
Fantastic. Thank you. Thank you for that response. I have just one more question before we wrap it up here. Could you provide some tips to cultivate good debt practices, please?
The first is you have to be a very disciplined person. Generally, the way you approach your finances as a person, most times when you approach your business finances, you have to be very disciplined. When you take money from people, you must understand that there's an obligation, and that obligation that is on you means you have to be very disciplined in how you use the money. First, don't be carried away when you have money, and like I said, it applies to you also your personal life. That discipline, budgeting, that discipline helps whether it is personal finance or business finance. The second is, to cultivate good debt practices, is you must record, you must measure the things you're doing. To be fair, some people are not, why some people have bad credit scores or have bad habits. It's not because they don't have integrity or they want to be fraudulent. It's just because they've not tracked what they're doing. They don't measure what they're doing. What you don't measure, you can't improve, right? So whether it's your business, if it's a business, if you don't have very solid financial management records, your credit will be in shambles. You need to sort that out. In your personal life as well, you need to at least have something that helps you track what you're earning versus what you're spending. It is when you measure and you track, it helps to improve your discipline on what you're doing, right? And like I said, the third is, be very wary to take debts that you don't need. Don't take debts except you've carefully thought through every single thing you need. And don't take debt for something that is not appropriate for.
Thank you so much, Madam Tosin, for sharing your knowledge with us. We dearly appreciate your time. So from here, I will be returning the mic to Chidinma to usher in the next moment. Chidinma, you have the mic.
Thank you so much for that fantastic presentation, Ms. Tosin. I know we got value. So if you got value from that presentation, can we see your comments? Can we see your emojis in the chat box? Can we say thank you, thank you, thank you? Thank you so much, our fantastic moderator as well. Thank you, we got value, good debt versus bad debt. I believe we now know the difference. So moving on quickly, we are moving on to the next presentation. I know some of us are interested in blockchain and AI and digital money lending. Okay, thank you. The emojis are still coming in. Thank you so much. All right. So I'll be introducing the next moderator who will be taking us on enhancing the credit industry with blockchain and AI, the value of digital money lending and improvement of consumer credit in the Nigerian economy. And to moderate that session is none other than Mr. Lee Uchioma, who is the CEO of Coin.
Hello. Hello. Can everyone hear me?
Please, if you're not speaking, kindly mute your mic so that we can enjoy the rest of this presentation. We're going to mute you if you are not speaking. Thank you. All right. So Mr. Lee is the CEO of CoinNews Extra, Africa's premier cryptocurrency, blockchain, AI, and fintech media platform. With a keen focus on fostering innovation and financial empowerment, he has dedicated himself to helping organizations, governments, and individuals harness the potential of emerging technologies. So Mr. Lee is well prepared with his team of panelists to take us on digital money lending and blockchain and AI. So over to you, Mr. Lee.
Oh, thank you very much, Chidema, for that introduction. So welcome.
Please unmute your mic, Mr. Lee. Your mic is muted.
Okay, can you hear me now?
Yes, fantastic. Thank you.
So sorry for that. Thank you, Chidema, for that wonderful introduction. And thank you everyone for joining us. We thought it wise to come up with this conversation. We are going to, not wasting much of our time. I'm going to be able to introduce the panelists in the person of the first on the list there is Yerins Abraham. Yerins, you are welcome to this panel. Also on the panel is Dr. Harry Atuanu, and also joining us is Olubumi Fabonwa. Well, guys, I'm happy to have you on this panel session. I hope all of us are here. So we're proceeding. Our topic is enhancing the credit industry with blockchain and AI, the value of digital money lending, and improvement of consumer credit in the Nigerian economy. I'll give you guys just 1 minute to just introduce yourselves, who you are, then we proceed with the conversation. So let me start with Yerins. Yerins, please go ahead and introduce yourself.
Hello, everyone. I hope you can hear me. My name is Yerins, and I'm a founder, entrepreneur first, and I'm an enthusiast of blockchain and tech in general. It's really nice to be here. I have both a medical background and also a creative background. So for the past 5 years, I've been delving into blockchain and AI. So there's still other things. Maybe one of you might know me or stuff like that, but all the same, it's really nice to be here, and I look forward to having a good conversation with you guys.
Okay, thank you very much. Next, Dr. Henry Atuanu, please introduce yourself more.
Good afternoon, all. My name is Dr. Ationu Henry. I'm currently the Vice Chairman of Money Lenders Association and also the pioneer CEO and founder of Hit Finance and Investment Company, owners of Hit Money. I'm delighted to be here today. It's been an exciting season, and I hope we all enjoy it. Thank you.
Thank you very much. Nice to have you on the panel. Next is Olubumi Fabonwa. Olubumi, please introduce yourself.
Hey, hello, everybody. It's a huge pleasure to be here. My name is Olubumi. and I'm a founding partner for a platform called POTS, and also work with Binance Africa full-time. I manage the affiliate program and also do business development with Binance. And I have a big background in banking, commercial banking actually. So I have a lot of interest in credit scoring, and I think this is going to be an exciting conversation. And I congratulate everyone that is on this in this session, because you are going to be listening to the top guys and you'll be learning a lot. So glad to be here. Thank you.
Thank you very much. So nice to have you all on this panel. Okay, so
when you learn from me all the time, Mr. Yeah, Mr. You are plenty with you are plenty with Mr. Yeah. I wish I on the no weather issue.
Hello, can you mute? Okay, let's proceed with the panel. We have some questions here. Let me proceed with Yerins. Yerins, let's look at how might the use of AI in credit scoring impact bias and fairness, and what steps can be taken to ensure equitable outcomes.
Okay, okay, can you hear me very well?
Yes, please go ahead.
Okay, so so to start, your question is about AI, how it can impact biases and fairness in credit scoring. Yeah. Okay. So first of all, AI, people have a particular perception about AI that it's basically the information you give it that, but basically it's the information you give it that it will deal with. And when humans are interacting with AI, we most times might be a victim to bias with AI, especially with something like credit scoring. The best way for it to actually be fair in integrating integrating credit scoring with AI is to ensure fairness, diverse representative database, regular auditing, and refining the AI models. This is very good. You can also incorporate ethical guidelines. So like I said, the AI is just a machine that if you ask it what you want, it gives you what you want. And if you are not aware of these ethical responsibilities you need to do while interacting with the AI, you might end up having a database or a database that has a biased historical disparities. So basically, the most important thing is incorporating ethical guidelines, promoting transparency in decision-making process is very, very important when integrating AI to credit scoring. And that's the best way. So like I said, just be aware of the limitations of the AI and then feed it as much important information as you can to get a very accurate, less biased result. Hope that's understandable.
Nice one there from you, Yaris. Let me look at Dr. Henry. Let's look at how can money lenders tap into benefit from the full-scale debt to recovery measures available in the system, like the global standard instructions, that GSI. Dr. Henry, can you hear me?
I can hear you. Sorry, I was unmuted. I'm unmuted now. I was muted before. Yeah, the GSI, Global Standing Instructions, was came into effect. The memo by CBN came into effect in 2020, around July. Before then, let me take us back to history. Before then, there was low loan given to individuals in the economy. So in 2019, the CBN encouraged the banks to give out more loans, to individuals. And that informed banks to start relaxing their credit risk criteria in order to accommodate more individuals. And that's part of the non-performing loan, extralogically, that banks had huge non-performing loans in their portfolio. So the CBN came about the idea of the GSI. So the GSI in itself is like a last resort to collect money, and it's limited only to your principal and interest accrued. Does not cover anything else, does not cover your default charges or other penalties. However, for you to benefit from it, you must be a participating financial institutions. And most of the participating financial institutions are either registered by CBN or they are banks, which are deposit money banks. Initially, they did not even include the microfinance banks initially. So the microfinance banks are just currently being onboarded into the GSI. The way the GSI works is that if you take money from Bank A, they will link your other accounts in other banks, whereby once it defaults, Bank A can go to any other bank you have account with and collect your money. Before now, if you have, say, 3 accounts with Bank A and you are owing on one account, Bank A cannot even apply that, loan on other 2 accounts you're having with them. They cannot. But with the GSI, they can apply to their own account. They can also apply to other banks' accounts. So it's a very good initiative that banks can now recover back money from other banks that individuals have current account, savings account, or deposit account in. However, for most money lenders, they are not regulated by CBN, and they are not deposit money banks, which means officially they cannot collect deposits from customers. So that makes it a bit tricky for most of the money lenders. They cannot, use the GSI. Even for the microfinance bank, the GSI has just going to be introduced to accommodate the microfinance banks. CBN just made the pronouncement. They've not even come up with the guidelines yet. So, but for most money lenders, it's going to be a big challenge because we are not deposit, taking institutions, okay? And most of us are not regulated by CBN. However, there's a way we can partner with the deposit money banks. We can, for example, form a strategic alliance with our key bankers. If I'm banking with, say, UBA, I can discuss with UBA. They can link me in with their own GSI, let me call it license for lack of word. So they can collect on my behalf for my customers that are owing me, because I'll give them all the details there. They can debit the customer's account using their own platform. They can debit other banks that the customer has an account with. So these are the ways, some of the innovative ways that the money lenders can be accommodated in this field, okay? Because without this, the money lenders are also suffering what the banks were suffering in 2019. They have huge, the portfolio of non-defaulters, and they cannot reach these borrowers because they keep going from one money lender to another. So one way is for the CBN to allow banks to integrate the money lenders or those that are not registered by them, to their GSI platform. Thank you.
Thank you very much, Dr. Henry, for that insight. Let me come to you, Olubumi. What role, we see what DeFi is really doing in this in the financial sector. What role can decentralized finance that DeFi play in reshaping the credit bureau industry landscape and risk that will be considered while trying to migrate? Olubumi.
Okay. Yeah, so the topic of decentralized finance, for people that don't know what exactly DeFi is, that's decentralized finance, and it's a very interesting one for us to be able to apply it to credit reporting, credit scoring, or credit registry, like the question has been asked. And I would say that DeFi would not just only reshape the industry, I think it's going to change it forever. Just permit me to be able to use that nuance. And again, it's a very interesting one. And what DeFi does is that it allows for decentralized lending and borrowing without the need for regular traditional financial institutions, banks, both microfinance, deposit money banks, and what have you. So it gives the power, it takes the power from these centralized authorities more to the hands of the regular people. So it means that as parents or as an individual, I can give out loan facilities to somebody that is in need and that probably is not captured, does not have a credit history, or does not have his history, does not have any credit score, as the case may be. And take Nigeria or Africa as a landscape, for example, based on what the first question that Yeris answered, the AI models that are probably going to be applied may not take into cognizance a large demography of people. So me, for example, that I'm a small scale business person, would probably not have access to credit because I don't have history of credit from deposit money banks or other financial institutions. So that means that DeFi helps me to be able to take credit from individuals or from small organizations based on certain terms without exactly relying on centralized authorities, as the case is right now. And I think also what DeFi helps us to do, it helps to take away that geographical barrier. So that means as an individual, I'm currently in Nigeria, I can take a loan from a Swiss individual, from somebody in Switzerland, or from somebody in Denmark, or from somebody in the US. So it is more, it takes away that geographical bias or geographical barrier to be able to borrow or to be able to lend. And in terms of risk, I think the first and most important risk is the regulatory barriers or regulatory uncertainty that we have. So at the moment, regulation is practically behind innovation. So innovation has gone ahead. We want to make things easier for us, but regulation is still lagging. So I think that's one of the risks in terms of how DeFi can be regulated. We do not have that. We do not have any structure in place at the moment. So I think the other thing is also user education. So a lot of people probably do not, I've never heard about DeFi. A lot of institutions, a lot of organizations, a lot of governments have no idea what DeFi brings to the table. So before you can even say that you want to apply decentralized finance to credit scoring or lending or borrowing, we have to ensure that there is user education. So people have to understand DeFi platforms. People have to understand DeFi protocols. People have to understand the vulnerabilities that exist if you are lending or borrowing on a DeFi platform, and the fact that there can be potential financial losses to it. So yeah, I think that those are some of the things when it comes to decentralized finance, applying that to credit scoring or credit registry.
Interesting. It's very interesting. Talking about the farming, yield farming, and all the rest of them that are involved in DeFi. DeFi is a very interesting area that we look forward to having in the credit bureau industry. Let me move over to Dr. Henry. Dr. Henry, let me hear from you. How do we make government and other relevant agencies, especially the FCCPC and others, also protect the interests of loan companies where case of fraudulent customers are established? Dr. Henry?
Yeah, thank you. The FCCPC, there was an acronym for Federal Competitions and Consumer Protection Commission. It's an agency of the government. Before now, they were not regulating money lenders, but recently, about 2 years ago, they came up with a policy that all digital money lenders must register with the FCCPC. And before now, I'm sure most of us must have realized the practice in the industry whereby money lenders now, shame defaulters. They will put their pictures on their on internet pages. They will send messages to their contacts, etc. So this got the FCCPC worried, and they now insisted that all money lenders playing in the digital world must register with them. They came up with the regulation 2 years ago, and most of us are now registered with them, as an online, lender. However, to a large extent, like their name depicts anyway, they protect only the consumers. So most of the time, consumers come to the digital money lenders, they borrow money, they don't repay, because most digital lending do not have that physical orientation with their customers. They do most of their engagement online. Most of them does not even know where these customers live. They can even pass them on the road. They will not even know that this is my customer that's owing me money. So they resort to, what I would call in brackets, shaming and, naming them, publicly on the internet, etc. They will now in turn start screaming that these money lenders are, harassing them. Meanwhile, they are the one not paying in the first place. Okay, FCCPC will now, slam on the money lenders without also protecting the money lenders, because at the end of the day, this money they are giving out are customers or depositors' money or money they have borrowed to do business. So I think a way they can do it will also be to also caution, these customers that come to make report, to also protect the money lenders, because if you kill the money lenders, there will be no more money lenders to give money to these customers in the first place. So if a customer complains to you, at least it's also hear from the money lender's perspective, and also look for a way to also, punish the customer or make the customer pay back, either by way of having your own, mini database whereby you put all these customers' name there on your own, and also try to enforce them to also pay back, the money they are owing. Yes, on one hand, protecting the customers for being shamed. On the other hand, you also need to protect the industry. Because if you protect all the customers that protected the industry, there'll be no industry again for the customers to go and borrow money from. So I think the FCCPC to also protect the money lenders as well as they're trying to protect, the customers. Thank you.
Thank you very much. Yes, that's very insightful point there, because the lenders also need to be protected. Most of the conversations are going to the borrowers. They are the ones making more of those complaints, and it's as if the lenders are not. They don't really need protection. That's a very nice one from you, Dr. Henry. Let me move over back to you, Fabon. Let's see how we can balance innovation and privacy. Even though we are talking about blockchain in the credit bureau, how can the credit bureau industry balance the benefit of innovation with the need of consumer privacy and data rights? Fabon, can you hear me?
Yes, absolutely. So, I mean, there are a couple of ways. It's very important for you as the credit registry to be able to balance this innovation, which has to do with blockchain technology and artificial intelligence that we are speaking about, with protection of consumer privacy. So one of the risks that you may run into when it comes to utilizing some of this tech or some of these innovations, is ignoring the fact that you still have to protect the data of your customers, and your customers or your consumers still have data rights. I think the first thing to do to be able to to get a balance is stakeholder education. And the stakeholders in this case are your consumers, that's all your users, the stakeholders, your employees. The stakeholders also is the regulators or the government, as the case may be. There's a need for us to be able to educate these people about the importance of privacy and also data rights. And this kind of platform that we've created, that's been created by Africa Credit Expo, is a very good place to be able to do this, to conduct forums like this, sessions like this, and also there needs to be training sessions over time. The entire industry is supposed to come together to be able to have training sessions on the best practices when it comes to data privacy, to look at other places that we call SENA crimes. Let's see what they are doing in terms of data privacy. Let's see what they are doing in terms of consumer protection, data protection. And I think the other thing is also to create regulation. Now, this is on the part of the regulators or the government. Everybody plays a part, but most of the responsibility falls to the regulators to be able to create actual guidelines for data protection and also compliance, because there's need for us to create these guidelines in line with what exactly is obtainable in the space, especially bringing in blockchain technology, which decentralizes everything, and also artificial intelligence, which make things easier, which make credit scoring easier, and gives us more data to be able to feed on in order to be able to confirm if someone or a body or an institution is credit worthy. So there needs to be regular review or an update of different policies as innovation continues to increase or improve. We have to improve on these policies to ensure that they actually align, and there needs to be oversight function in terms of compliance. So compliance is something that has to be viewed in a very macroscopic lens. So the regulators have to have an actual oversight and to be able to call organizations like Dr. previously mentioned to order, both the borrowers, the users, the consumers, and also people, the lending parties to order. That oversight function is very, 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 very important. So this is how I think that the entire industry can be able to balance both the influx of innovation and the need to protect consumer rights, and that's data rights, and also protect the consumer and or user.
Okay, thank you very much for that. I really appreciate that input from you. Yaris, let me hear from you. What are the key challenges and opportunities in, when we talk about transitioning to the credit bureau to technology, blockchain, AI? What are some of the opportunities and challenges that they may encounter while trying to transition to blockchain and AI-driven model?
Okay. So transitioning, the reason why the AI and blockchain exist, mostly starting with blockchain, blockchain is really known for its transparency and security. And, one of the reasons why it's used all over the world, whether with cryptocurrency or whatever technology that is built out of this blockchain technology, is the fact that it offers a system of security and transparency that has never been explored before. And in every sector, if anyone digs deep enough, you will understand that blockchain is can actually provide a very huge margin of value to that sector. And like the credit bureau, I know that there are lots of needs that this blockchain can come into. And transitioning, right now, one of the things that blockchain is still trying to do is teaching people about this technology, and it's something that we have been trying to do, we are still doing, and I feel like that is something that will be one of, I don't know if I'll call it a challenge, but it's a process. It's part of the process of transitioning, because there's a whole lot. I don't think it's a very complex technology, but at the same time, knowledge helps make the whole process better. So yeah, I don't think it's also a very technical transition. It's going to be very easy, but in terms of the value that blockchain will provide, the major values is security and transparency, which it's something that you cannot really, I talk about this a lot. Humans are the desire for us to cheat is very high. We underestimate it. We underestimate our desire to figure out ways to do something to exploit someone. And when there is a technology that you can see what someone does, and you can also track how this thing is done, it brings trust and growth to that particular industry if a blockchain is used. So yeah, that is it. I like I said, the transition is not something that will be tedious, but at the same time, being open to learning about it's something that is good. Now for AI, for me, I've been using AI for the past couple of months back to back with some of my company and some other stuff I'm still learning. And one thing that I know about AI that is so good at doing is analytics, and over time, this is going to be needed in terms of growth. If you look at big companies now, like few days ago, they were laying off lots of employees. Big companies like Google, Apple, and some other companies in Silicon Valley, they're laying off lots of employees because there's like there's this um, opportunity that AI is providing that has never been seen before. And humans, no matter how we try, we cannot provide such kind of values to their system or their company. So if you are well aware of the how good AI is, you can use it to its maximum abilities and enjoy its benefits to the maximum and help it grow your business. So an unimaginable measure. AI is amazing. Like I said, with people using AI, we need to be careful too, because if you're building an AI, let's say you're using an already existing AI, there's limitations because you have to also be careful with overfeeding it with your information, your company information. It depends though. And also if you're using, like, let's say you're having a plugin from ChatGPT that you want to use to connect with your platform, there's also limitations because it has a specific amount of knowledge it has. So you have to feed it. Now, feeding it information or feeding it knowledge is also very, very complex, or it's tricky because you can feed it a biased information. So you have to be self-aware of the kind of information you're feeding it. You have to include policies to stop it from going over the board, or giving you some kind of stuff that might not, because a friend once told me that is AI or is computer more intelligent than human. And one thing that I told the person back is that humans have this ability, this creative ability. We can picture something, and but for AI, it only dwells with the information you give it, and it like tries to navigate and all. And same thing with computer too. So when you understand that, like if everybody in the world calls a cat a dog, and then you tell an AI what is a dog, it will show you a cat. I don't know if that's confusing, but it's only the information you give it. Yeah, so you have to constantly remind yourself. So let me just summarize. For blockchain, amazing technology. For transparency and security. For AI, you have to, if you want to dwell in analytics of your company, how to navigate, where to reach in the next couple of months, all these information can be given with AI. So it's very, very awesome to use these two technologies. And yeah, transitioning you will need to just be willing to learn more and more. There's no time, there's no like, oh, I'm done learning about blockchain, I'm done learning about AI. Every time there's either a new technology, there's either something trending, and you have to learn more about that thing and see how you can incorporate it for your company or your sector to grow. Thank you very much.
Okay, thank you very much, Yerins. This is a very nice conversation, but I know that because of our time, this kind of conversation is not conversation that can be finished in a day. I know it takes time to comprehend and also understand that. We've been able to look at enhancing the credit industry with blockchain and AI, the value of digital money lending, and improvement of consumer credit in the Nigerian economy. So let's look. I don't know if we have time to still take questions. Let me see if there are questions. I know our audience, if you or people that are with us, if you have questions, please do where to drop them. Let me see if there is any question here. Okay, there is one question from Ochmania. Oh, is it legal for money lenders to collect their money through banks? Through banks, GSI. I believe this for Dr. Henry.
Yeah, thank you. I was actually trying to respond to it on the chat. Legality is it's relative. Yes, it is legal if they are licensed and approved by CBN to do that. But for you to take benefit of the GSI, there are certain criteria you must meet. You must be regulated by the CBN. You must have the IT and infrastructure required to connect you to the GSI platform through the NIPS, okay? And thirdly, you must be a deposit, money bank, you must be able to open an account and to collect deposit from the public. So if you don't meet this criteria, automatically you cannot be, licensed by the CBN to operate the GSI system. So yes, I will use the word legal because if you don't have a license, you can't even do it in the first place, except you are approved. So once you are approved by the CBN, yes, it's legal and you can do it. Also, the question should actually be whether they are approved or whether they can be approved, not whether it is legal or illegal, because they cannot do it anyway if they are not licensed to do it by CBN. So yes, anybody can do it if CBN approves the institution to do it. And there are some criteria you must meet for CBN to approve you to take advantage of the GSI. And like I said, initially it's just the commercial banks, but lately they are considering to include the microfinance banks too to the platform. And probably eventually they might include other financial, service institutions like the money lenders and finance companies to also enjoy that benefit. But before you can be there, you must have the infrastructure, the IT, and the platform to connect with the NIPS so that you're able to, do the things you're supposed to do at the back end. Thank you.
Okay, thank you very much. Because of our time, I know our speakers, our panelists are also here. So if you have questions, they will be able to be answering them on the chat. I know our time is up. So thank you very much, Dr. Henry Atong, for joining us on this conversation.
Thank you very much. It's a pleasure.
Yeah, it's our pleasure. Thank you, Olubumi Fabonwa, for joining us on the panel.
Thank you very much. Pleasure.
Thank you. Thank you, Yeris. Yeris Abraham, thank you for joining us.
Thank you. Thank you for having me. It's a pleasure. Thank you.
Okay, thank you, everyone. My name is Lee Uchomohiri. I really appreciate this opportunity to moderate this panel. So I hand over to you, Chidima, to continue with the conversation. Thank you, everyone.
Thank you so much, distinguished moderator and panelists. I believe we've gotten value from that session. Can we see your emojis, your comments in the chat button from this segment? I got value personally, so I don't know about you. So can we see your comments, your emojis? Speakers. Thank you. Let's keep them coming. Thank you. All right. Because of our time, we'll be moving on to the next segment. Okay, thank you very much. This slide's coming up. All right, and then we're going to be looking at the ultimate payment plans, smart spending or financial trap. And what we're going to learn is the advantages and disadvantages of payment plans, how to weigh the pros and cons of payment plans versus outright payments, how to choose the right payment plans for your needs, how to use payment plans to your advantage, and tips for avoiding financial pitfalls. So we know that it's a new year and some of us are yet to set our goals. Some of us have already set our goals. And some of us might want to look into buying a new house, a new car or appliance. And you want to know, should I pay outrightly or should I do a payment plan? So this segment is going to be very informative to help us make that decision. And to do justice to this topic is none other than Mr. Adeyemi Zenith, who is the Group Head Sales of Credit, View, and he's a business solutions provider, value and All right, sorry, we had a little technical glitch. So over to you, Mr. Zenith. Mr. Zenith, you can take the floor. You're muted.
Can you please share the screen?
Yes, we'll come up with it.
Thank you.
You can proceed, Mr. Zenith.
Oh, okay. Yeah, good afternoon. Okay, my name is Adiyemi Zenith, the group head of Credit View. I'll just be talking to us about the smart spending versus the financial trap. So I know that some of us would like to, we've been faced with some situations that we're actually thinking of whether to get something, outrightly purchase it, or to spread the payment. So I'm just here today to discuss the pros and cons of that on how to choose whether you want to like spread your payment or you actually want to pay outrightly. So we'll just go through some slides and we'll just take us through. Then you can now drop your questions. As I'm speaking, you can drop your questions, and then from there we can proceed to answer those questions. It's just for me to shed some light to it and from personal experiences. Thank you. Next slide. Okay, so I just did the introduction about that. Now, the question is this: what are actually our payment plans? These are the payment plans that allow us to pay for a purchase over a period of time. It is actually, for many people, it is convenient to do it that way. The payment plans also provide immediate access to goods and service. You needed to get a particular asset, and then you have the money to pay outrightly, or you want to spread over time. So payment plan, if you have the opportunity to, you are given the opportunity to actually spread it over time, that means that you are having access to that particular asset immediately. So those are the, so we'll actually explore more and see the benefit of it, the disadvantage of it, and why you need to choose a payment plan or you actually go for outright purchase. Now, what are the advantages of payment plans? One of the things that does to us is called budget flexibility. Payment plans offer the advantage of breaking down large expenses into manageable chunks, providing individuals with budget flexibility. For example, 2024, you already have your budget, things that you need to achieve for the year. Now, providing you with a payment plan give you that flexibility on how you can manage your budget. So for example, let me use myself as an example. While coming into the financial industry, or let me say into the credit business, I'm someone that actually believes that anything I want to get, I save up for it and I get it. I actually save and I get. But along the line, I began to discover the opportunities that payment plan has to offer. And you began to see a lot of people that what you're actually trying to save towards, they're actually getting it because they choose the option of the payment plan. Cinema, I can't see the screen again. Hello? Hello? Yeah, the screen. Okay, thank you.
Sorry about that.
It's fine, it's fine, it's fine. So another thing that payment plan does is that it improves our cash flow. By distributing the payment over time, cash flow is enhanced, making it easier to meet other financial commitments because you have more cash flow. For example, you have, let's say you have 1 million as your budget, and at the same time, you needed to achieve like 3 or 4 things. Instead of concentrating that 1 million to achieve a particular item, because you have option of payment plan, you can actually use the same 1 million to achieve 3 or 4 assets at the same time, and you become the owner of the particular asset, or you have access to that particular asset at that time, instead of using the bulk money of 1 million to get a particular one. For example, maybe you need to get a phone, you need to get maybe a car or what have you, and then you have these options in front of you. Meanwhile, with your maybe your 5 million, you can get maybe like a small car, you can get a phone and all that. But one car alone right now, maybe if you're even going for a fairly used car, maybe let's say a Camry 2009, maybe a fairly used, maybe you're getting it around 3.5 or 4 million. Meanwhile, you only have 5 million as a budget. Now, someone like me will use that same 5 million, and then I can go to an auto loan dealer. I want to take this loan, take this car, and I want to spread the payment for 12 months. I can also go to where I want to get my phone. I can also spread it. Now I can have like 4 assets immediately, rather than just use that 5 million to get to 1 asset. So it improves my cash flow, and I can use the other money with me to do some other things. Now, another thing is that it affords us the access to quality products. Payment plans enable us to have access to quality products, and because sometimes to get some quality might be financially challenging. Now, because you have opportunity of having to spread your payment over time, then you can actually have access to a quality product that you wish, instead of going for a lesser product because of availability of cash. Then it is convenience for you, or it takes the burden off you, whereby looking for a substantial amount of money to purchase an asset. This is actually convenience, and easily you can access this. Another thing that a vital thing for us is that a payment plan helps you to build a credit history. There are some organizations today, like my organization, if you have not built up a credit history, it is difficult for us to avail you any loan. That is the truth. Because why? We want to know your repayment capacity. We want to know your character. We want to see your history, how well you have been building your credit score. In fact, in America, if you don't have any credit score, you cannot access anything. So it is always advisable that you buy things and you spread it over time. In fact, majority of what we do in Nigeria, that we just go ahead and get things outrightly. Over there, it doesn't happen that way. You have to spread the payment, even if you have the money. Spread the payment. Let's see how good you are. Let's see your character by paying on time. So by you embracing a payment plan, it actually helps you to build your character. Next, please. Now, these are the disadvantages of payment plan. No, we've been talking about the advantages of it, what it is, and what we need to know about it. Now we're going to look at the disadvantage, because this session is just for us to look at the pros, the cons, the disadvantage, and the advantage of it. Now, one of the advantage of this payment plan is that you have accrual of interest and fees. Some payment plans come with added costs, such as interest or additional fees, increasing the cost of the purchase. For example, you saw a car that you need to buy, maybe at the dealer spot, you can get it for, let's say, 5 million. So if you approach an auto loan office, By the time they added the insurance fee to it, added the management fee, administrative fee, and all that, it will be more than the cost that if you have your money, you can just get it directly from the dealer spot. Another thing is overcommitment risk. Easy access to payment plans can lead to overcommitment, like I was saying. So because I have access to those plans, then that means I can actually be overcommitted. I can have like 4 or 5 assets that I'm financing at the same time, if one is not well disciplined. Then another thing is it impacts on your long-term finances. Continuous reliance on payment plans might impact long-term financial goals, as cumulative costs of multiple plans can add up and affect the overall financial health of someone. So, for example, when we look at some people's bank statement, you want to access a loan, and by the time we look at the statement of account, we are looking at the fact that this person is actually over leveraged. Why? Because you are servicing this loan with this organization, you are servicing another loan, you also have an asset you are financing, you have like 3, you see people have like 3 or 4 things that they are doing at the same time. So those are the designs of the payment plan, even though you can access them, but in the long run, sometimes if, like I said, we are not disciplined enough, we are not able to look at your budget critically and see that this is the way we want to go, it can actually lead to impact your long-term finances. Then default risk is high. But because you are having so many payment plans at your disposal at the same time, it can lead to you not performing well in one and performing well in the other. So your default risk is actually high. Next. And that's actually going to damage your credit score. Now, the pros and cons of payment plans versus the outright purchase. While payment plans provide immediate access to goods and services, they can also lead to additional costs and debts, which I've mentioned the other time. Now, when the pros and cons of payment plans versus the outright purchase involve considering various factors, and these factors actually include your financial situation, budgetary constraint, credit score consideration, then interest rate and fees. Now, looking at this financial situation, budgetary, credit score, we will now look at the pros and cons. And I believe that by looking critically at these pros and cons, you individual will be able to determine whether they want to go for the payment plan or the outright purchase. You will see the benefits and why you actually need to go for this and not the other. So looking at this now, the pros of the financial, so the financial situation that you find yourself. So the payment plans of that, the pros is that you provide immediate access to product or service with minimal upfront cost. That's the, if you are minimal upfront cost, that's what you get. Now for the outright purchase, you avoid interest fees that is associated with that payment plan. So if I'm going for the payment plans, I have the interest fees that I need to pay for. But if you are taking the outright purchase, you avoid it. Now, the cons of it is the fact that long-term, for the payment plan, long-term commitment may impact overall financial stability. So it might make you to be stable because you have a long-term commitment plan under the payment plan. So you are financially stable. You are able to do certain things and many things at the same time. You can be stable. Now, for the outright purchase, it requires a larger upfront payment. So you have to look for a bulk to pay initially, which might actually impact your cash flow. Now, that's the financial situation. Now, I'm looking at the budgetary constraint for payment plan. The pros is that you can break down those your cost into manageable installment. Isn't budget constraint. Like I said, I can actually take 2 assets and choose the payment plan because I know that I can use this money, let's say 1 million, to get a phone and the same 1 million to get a laptop, and I will spread it rather than use the entire 1 million to just get a phone. So I can break it down. Now, for the outright purchase, if you want to get it rightly, get it outrightly, it means that you avoid long-term financial commitment and potential additional costs. You just avoid it. Then another question you need to ask yourself is that, so that means like you belong to my school of thought then, that you need to save up to get certain amount because you want to get a particular project or you want to acquire a particular asset. For the cost of the budget that you have, the accrual of interest or the fees can increase the total expenditure. I think I mentioned in the last slide. Then the cost of it for the outright purchase is the fact that immediate impact on available funds, potentially limiting other spending. Because you've taken that large chunk of money to get this, you are limited in actually spending or to get some other things. Now let's look at the interest rates and fees. Now we are looking at those factors: financial situation, budgetary constraint, the interest rates and fees. Now, for the payment plan, it may offer 0% interest for a promotional period. There are some times that you see some promotion that, oh, there's no management fee, come and take this loan, or come and buy this, I'm not charging you any management fee. So if it's during the promotional period, you can actually avoid those interests. And that's why some people, when you want to get some assets, they actually wait for the promotional period, that they know that some things will be waived, and they actually get it. Now, the pros of the outright purchase is the fact that you avoid interest payment and fees that come with that financing. Now, it's possible for you to have, for the higher interest rates or hidden fees, which will increase the overall cost of whatever you want to buy. And the cost of it is that it requires a larger upfront investment. You have to pay heavily for it. Now, credit score consideration. Timely payment can possibly impact your credit score. It's not even can, it will definitely impact your credit score. And anytime, and thank God that thankfully this event is organized by Credit Registry, whereby they look at the credit score of individual, you dissect and get it. So it is better that for you to pay very well so that your credit score can actually increase. So the pros of it is also that no impact of credit score, as it doesn't involve credit agreements. So if you are going for outright purchase, you have no, so it will not impact on your credit score. You just buy your car or you buy your phone and you move on. So we don't know whether you have good credit history or not. Now, for the mispayment or default can negatively affect your credit. I've mentioned that because you have so many plans at the same time, you are servicing so many projects at the same time, and you are going through a payment plan. By the time you default in one and you're not fulfilling the other very well, it will impact negatively on your credit score. And if you take it to any borrower or any lender, they are hesitant to give you that money because they believe that, oh, one, you are over leveraged, or that you are not trustworthy enough. They look at your financial integrity. They look at your financial health, that this person, financial health-wise, is not financially okay. So they will not give it to you. Now, no opportunity to build credit through responsible payment behavior. Like I said, so the building of this credit score is very, very important in all that we do when we are thinking about our payment plan or even the outright purchase. And the sense in it, we are going to see it in the following slide on where are we supposed to choose. Now, there are some things that you need to choose just to consider when you are choosing your payment plan. Now, the product and the lifestyle or the lifespan rather of that particular service will require you whether to take a payment plan or to get it outrightly. Now, payment plans, they are actually suitable for long-lasting items or ongoing services. So I'd rather take a loan to get to a payment plan to get a loan that I can buy my car and spend for 2 years, rather than take the old money and say, okay, I want to get this car outrightly. It's for 2 years and I'll just quickly pay. Outright purchase is ideal for short-lived products. Upfront cost may be disproportionate, yes, but it's actually ideal. If just a short lived product that you quickly want to get, you can just go for your outright purchase and you are fine by that. Now we are back to your credit score. You can see that I'm mentioning more of this credit score because I've seen a lot of people and they will tell you that, but I'm doing this, I'm doing this, I'm doing that. But then when it comes to lending, what a lender or what we first consider is your credit score. What is it? Do you have good credit score? What is your repayment pattern over time? There are some organizations that even once you default 2 or 3 times or 4 times, they're like, They might not even come back for the second one. They might not even give it to you. So you have to restructure the facility. Now, timely payments positively impact credit, but missed payments can harm it. Now, for outright purchase, no impact on credit score, no opportunity to build credit. I do not have opportunity to build credit then because I have this belief that I'd rather save towards whatever I want. Let me quickly chip this in. While I was having that mindset, one day a colleague of mine just talked to me. Then I was still working with Skybank, which is now Polaris Bank. So and I was in charge of the loan facility and what have you. My colleagues will come, I will fill the form, underwrite the stuff and give it to them. And said, okay, when are you coming? No, come and see the land I just bought in my head. And I know how much we're earning there. And I was like, where did you get the money to get this on land? He said, but I took the loan from your office now. You guys were the one that approved it. I said, in this same industry? He said, yes. I said, you have a land? He said, yes. And we are earning the same salary. He said, yes. I said, okay. Then my eyes begin to open to the opportunity that is associated with payment plan. That, okay, you can eat. And I was actually saving towards getting one, but he doesn't really have to save. He just approached the bank and they assess him. He has a good credit score and he gave it to him. That gave it to him. So that actually changed my orientation that, oh, no, I need to build my credit score and I need to get this thing done on time. So a payment plan, another thing is flexibility and ownership. Immediate access to ownership with lower initial investments. For the outright purchase, full ownership and flexibility from the onset. So now look at this now, flexibility and ownership. If I choose the payment plan, I have low initial investment, but it's still mine. Now you have your full money. You're going to the market to get it. You have full ownership and you have flexibility from the onset, but we both have it anyway. Now, interest rate and fees may come with interest rate or fees, no doubt. And like I said, sometimes you look for a situation or a period whereby the company or the lender or what have you, they are on a promotional period whereby you can avoid some interest fee. There was a time that a particular company just said, oh, for every loan that you take between November and December, we are on a promotion period. We are not going to pay any management fee or any insurance fee, nor any processing fee. If I see such, I will actually jump at it. Now, emergency fund consideration. For payment plan, you preserve your cash for emergency fund. For outright purchase, immediate liquidity. For emergency, it reduces that. But if I choose a payment plan, I still have some cash for some emergency funds. But if I do outright, then it's going to reduce my funding. So we can now look at this very well and choose the right payment plan that you think it's good for you. Now, this is how to use payment plan to your advantage. First and foremost, if you are going into this, understand the terms and conditions. And you know, a lot of Nigerians, once you get the offer letter for any asset, for anything that you want to get, we don't even bother to look at it. Just how much is it? Don't worry. The next thing, we just put our pen, we just sign. Not reading the terms and conditions. And I can tell you the terms and conditions are actually put there so that you can read. But you know, this is actually derogatory. Nigerians, we don't usually read. And so I'm encouraging us to read. Read the terms and conditions, familiarize yourself with it so that you know before you take the payment plan. Now, look at your budget, evaluate your budget. How much do I have to spend on this? The next one is, I've said it, leverage promotional periods. Take advantage of zero interest or low interest promotional period if available. Then you can now spread your purchase. Build or improve your credit. If your payment plan is reported to credit bureau, like credit registry, consistent on-time payment can positively impact your credit score. Now, some customers will come and say, oh, I want to take this loan. And when you take their bank statement, you see that everything is fine. But because they've been taking loan from individuals that report the character and the payment to credit bureau, like credit registry, once you go there, we'll be able to see, but sir, ma, you have another loan with so and company. And you see the government saying, no, when did I take that? In fact, some of them have even taken the loan, they've forgotten they've taken the loan. So it helps us to, so you look at to build improve your credit score. You maintain financial flexibility. Use payment plans strategically to maintain financial flexibility so that you'll be able to like spread your payment and you are flexible in your payment. So it is convenient for you to, so I wanted to get something in the office one day and I wanted to pay for it cash. And when I approached HR, oh, if I take this, how much will you be deducting? And later said I'll be deducting that. I'm like, okay, why would I allow myself to use almost 3 million to get this? When I can actually approach my organization, they will give me this and they'll be deducting it flexibly for me. And it will not really have impact on my financial goals and plans for the next 1 year or 2 years. So I chose that. Yeah, you negotiate your terms if possible. So, oh, can't you give me 6%? Oh, it's 6%. Can't you give me 5.5%? Negotiate the terms. Sometimes you can be lucky and you will get it. Then automate your payment. Set up automatic payment to avoid late fees. So this day we have you have the global GIS. This day you have your remitter. Then you have you have remitter. You have Paystack. You have a lot of payment plans that you can set up on your account so that you know you can even set a reminder for yourself that you are supposed to make this payment on the 20th. Put it in your calendar so that you will not fall short of building your credit score. So avoiding financial pitfalls associated with payment plan is crucial to ensure that you use this arrangement to your advantage. So these are just the tips. I've mentioned them, but this is just to actually list them. I will not dwell so much on them. So read and understand the terms. You budget for the payment. I've said it. Evaluate the interest rates. Now understand penalties that, like doctor was saying the other time, that the GIS is supposed to just take the principal and the interest, that it will not take into account the default charges. Now, if you do not understand the penalties very well, when you are coming by, you just think that you want to pay just the principal and the interest. Now, when you are taking a payment plan, understand the penalty that, okay, if I default, what is it? Some organization that you want to take a facility from them, they will tell you that if you come back after 2-3 months, that you even have your full money and you want to pay back, there are certain amount of money that you will pay. So if you don't understand it, you'll be having issues with the organization. But it's already there in their letter. That's why I said it's good for you to read the terms and conditions, understand those penalties, read it very well and understand it. Now, another thing is consider alternatives. You're not just stuck with one organization or with one asset. Explore alternatives, and that will actually make it more easier for you to know which one do I want to choose. Then if you don't really know, seek financial advice. Some of us are there to provide this financial advice for you to know which one you are supposed to go into or not. Then it will ease you of burdens of having to pay through your nose. Next. So in conclusion, now look, adhering to these tips and what we have discussed so far, you can make the most of payment plan while minimizing financial risk and pitfalls. Strategic planning and informed decision-making are key to leveraging payment. Plan for smart spending. Thank you. Question and answer.
Wow. Wow. Such a fantastic presentation. Thank you so much, Mr. Zenith. Can we see those emojis? I can already even see the cover. Oh, wow, we have a lot of questions in the chat room already. Okay, let's start with the first one. So Essay is saying, in a country like Nigeria, where today's price is not tomorrow's price for everything, including food, what would you advise, keeping in mind that salaries are not increasing? Very interesting question.
Yeah, okay. So I'll be able to see those questions.
Okay, great.
I think if you see them, you can quickly read them from your end, please.
Yes, so we're starting with SS question.
Okay.
She said, In a country like Nigeria, where today's price is not tomorrow's price for everything, including food, what would you advise, keeping in mind that salaries are not increasing?
I totally agree to this question. It's a, in fact, it's a mind-blowing question. And this is what almost every Nigerian faced when you want to purchase an asset. Like I said, what is your budget? Things are increasing, and the price of things are increasing. And it's not certain that your salary is going to increase. So I'd rather go for a payment plan. What is my budget? I try to stay within my budget. In fact, when we started the financial industry, there is a particular in your offer letter. Then you'll put there that your accommodation, that what you are paying for your accommodation must not be more than a particular percentage of your salary. And some of us actually stick to that because you don't want to be over leveraged. So your budget, what is your budget for that particular period? You know your salary, so you know your budget, and you want to acquire things. So I'd rather buy that thing now, or if I know that there's a particular company or that are given to promotional, I'd rather wait for that promotional period and try to take advantage of that.
Thank you so much. Okay, I see some hands are raised. Let me read the second question from the chat room, and then I'll call on you.
Okay.
So, so this next question, in your experience, what are some common misconceptions or myths surrounding payment plans, and how can individuals avoid falling into these traps?
For example, it is common in Nigeria that will say that, I don't want to hold debt into the new year. You hear people say that a lot. They don't want to hold any debt into the new year. You find that by November, December, if they get anything, they are trying to clear it. And there's some culture also in Nigeria, and it is our locality, that when it comes to payment plan, they don't want to. They don't believe in it. That even if you set up your businesses there, you have to like do a lot of education in their mind for you to actually succeed in that particular region. And I don't want to mention the name of those particular region, but you know what I'm saying, that they don't believe in all of these things, and it's a misconception. Now, if you look at the benefit of this plan, so why would I say that I don't want to hold into the new year? When I know that in the new year, I have to pay my school fees, I have to get a lot of things done, and you know that in the new year, you have 1st January, you have 2nd January, you have 5th January, like 5 times in January. Your January is even like times 3. A lot of things happen at that period in time. So I rather like look for a payment plan that will suit and ease me that burden of saying, okay, I want to satisfy everybody at the same time, or satisfy my budget at the same time. No, I'd rather spread it. So those are misconceptions that happen in our own region. And through education, showing bit by bit, like I said, I was a fan too. Someone told me that don't take loan to do anything. And that's stuck in my head. But later, when I see the colleagues around me and they are doing fine, how? And they think they are taking loan. And they are not sweating to pay it. I rather join them and learn how to get it done rightly. So I think the challenge here is not knowing the payment plan to choose, or not getting it right, or you look at your budget, but you are now like over budgeting for yourself. That is actually the discipline that we need to look at here. Thank you. How about answer that question?
Thank you very much. Yes, very, very relatable, particularly the one of not wanting to owe debts. New year, new me syndrome. Okay,
Yes.
so Omolara, your hand is up. Omolara, are you there?
Hi, good afternoon.
Good afternoon.
Yeah, well done. That was a very fantastic presentation.
Thank you.
Okay, so my question is just what type of payment plans are commonly available in Africa, and how do they differ?
And how do they?
Differ, like different.
Oh, okay, from each other. Okay, so I
Yes.
think the payment plan that we have in Africa, we have the monthly one, which is actually the most common one, monthly payment plan. Then we now also have some weekly payment plan. Then we also have what we call daily payment plan. So the daily payment plan that, that we have most of the time is for the traders, the artisans, and that the money that they take, you look at the type of their business, you know that, okay, what they get is they have a daily cash flow. So you rather set your repayment plan to get the daily cash flow. Someone in the market that maybe you get a phone of 50,000 and maybe you are in motion market and you are already fix your office around there. You want to go after that customer and get your money every day. And there are some organizations that do this very well. I know one in Ido Market. That's what they do daily. They get their money. Then the weekly payment plan has also been introduced, especially for the SMEs, because you find that SMEs, they normally get their cash flow around the weekends, then month end. So people start building the repayment plan around the weekly repayment these days. Then of course the monthly one that is okay every month, most especially for the salary earners. Then you build your monthly plan against that, and you set up your repayment instrument, whether it is Remitter, Paystack, and GIS, what have you that you need to.
Wow. Thank you so much. You see that the questions are still coming in. Temitope, you have your hand up. Hello, Temitope.
Yeah, hello.
Hi.
Good afternoon.
Good afternoon.
Yeah, Mr. DME, thank you for your eloquence and thanks for what you have shared today. My question borders on you've talked about a payment plan that is common in Africa, probably majorly Nigeria, but what happens when payment plans are made and with the inconsistencies and in future planning, due to the fact that the environment that we operate in Africa, mostly, so many things are uncertain. Job insecurity is there, business failures and what have you. How do one combat inability to meet up? Not always, but once in a while. What are there for one to consider?
So this is a very a crucial one for me to answer, because I can actually relate with that. So because of the instability that we have, like you mentioned the business failure, the job insecurity. So maybe I should just pick the aspect of the job insecurity. I think what most lenders do is that immediately you're out of job, or maybe you are laid off. So it's expected of us to go quickly and meet them and say, okay, see, this is what happened to me. This is the letter that, oh, I've actually been laid off. Then you now structure a payment plan with them. Yet they will still be disturbing you, asking you to pay the principal and the interest. But the fact that they understand that you actually lost your job, and so that's already a consideration for you. Now, even if it's a business failure, it's just for you to go back. What lenders and borrowers don't like is the fact that you have a mishap in your office or for your business, and you are not coming back to quickly inform them that, oh, this is what happened. Then that will make the matter to be more elongated. But if immediately you are able to come up with them, they might actually give you some leeway and give you some gap. Some might ask you that, okay, for now, we might suspend the interest for now. Maybe in another 3 months, we can give you that gap for you to land. But why most lenders do not allow that right now is because we don't go back to them to tell them about our own situation, that something has happened to us. Because I have seen in my wealth of experience over time that people that actually approach us to say that, oh, I lost my job, or there's a business failure, or maybe it's like something that happened yesterday in Ibadan, and so but I know one business there in Ibadan now that was affected. Now, if that business has actually taken a loan, can actually go back to the lender to say, oh, this is what happened. And when you present it and they know where your shop or your office is actually situated, there will be a consideration that will be given to you. Maybe a time for you to come back to pay, or they might actually restructure the whole facility for you. But like I said, we don't report them, and that is to our own mishap.
Thank you so much. I don't know if that answered your question, Tim Chokwe. Are you there? Okay, so our time is fast spent. I see that we still have some questions. Tega, please drop your question in the chat box so that our speaker can attend to it in the chat room. Thank you so much, Mr. Zeni. This has been a very, very insightful, enlightening, and educating section. Thank you so, so much, and we're grateful to have you here.
Thank you.
All right. Okay, so we're going to be moving on to the next and the final segment for today. And it's a very, very interesting topic. I know some of us might have come to this webinar, so please do not leave without participating in this session. It's I want to be a millionaire. Do I need a smart score? And that is a panel session, the very final one for today. And to moderate this session is none other than Temitayo Shada, who is an accomplished HR professional with progressive experience in managing human resource operations and driving strategic initiatives to support organizational goals. She boasts over 10 years of extensive experience in diverse functional areas built around HR management. She has held various HR roles previously, and she's currently the HR manager in Credit Registry. Can we warmly welcome Temitayo Shada as she moderates the last section for today? Over to you, Ma.
Thank you so much, Chidima, for the warm introduction. Good afternoon, everybody. I'll be moderating the last panel session titled, I Want to be a Millionaire, Do I Need a Smart Score? So briefly, let me tell you about the session. For this session, we have a lineup of credit bureau experts from Credit Registry that will enlighten us on the topic, I want to be a millionaire. They'll let you know whether if you're planning to buy a home, a car, or start a business, why a good smart score is essential. This session will teach you how to protect your credit and how to get the best and possible interest rates when you apply for loans. So you can, avoid surprises when it's time to get a loan. At the end of the session, you will learn how to check your credit reports for errors and derogatory information. You learn how to dispute inaccurate information. Peradventure, there's inaccurate information on your credit reports. You can dispute that and seek redress. You learn how to keep your credit reports accurate and up to date. Also, you learn how to handle disputes with lenders. So we have various speakers. So the first speaker will be Mr. Kalu Abosi. Mr. Kalu Abosi is the managing partner at Astor Law Firm. Mr. Kalu is a seasoned lawyer specialized in financial law advisory and dispute resolution. Mr. Kalu Abosi's leadership extends to his past role as chairman of the Capital Markets Committee of Nigeria Bar Association and his involvement in reviewing primary security legislation in Nigeria. Mr. Kalu Abosi this afternoon will be opening the session by speaking to us and enlightening us about the rights of consumers and also the credit report. So, Mr. Kalu Abosi, you have the floor. Over to you.
Hello, thank you. Good afternoon, everyone. Can you all hear me?
Yes, we can hear you, Mr. Kalu.
Okay, very well. Thank you, Ms. Shada, for the kind introduction. And thank you, everyone who's joined since noon. And I've been following the different discussions that's gone on. It's interesting talking about enlightening you on your rights and the things you need to do. I think the fact that you're even attending this session says that you've taken the first right step in terms of getting education and preparing yourself for the credit market to be able to assess credit and to be able to do the things that are proper in terms of how to increase your score, how to get money, and in the event of dispute, how you are going to navigate with different lenders and ensure that issues with one lender does not, how do I put it, impact negatively on your ability to access credit from other institutions. As you may know, the legislation or the law that governs credit reporting is called the Credit Reporting Act that was signed into law in 2017. And what the law essentially does is to spell out the rights of lenders, spell out the rights of consumers of credit, that is people who borrow money, and even credit bureaus and every person who is in the credit ecosystem. Basically tries to protect everyone and give a level playing field. So for a start, I've had in one of the sessions where one of the lenders talked about the Federal Competition and Consumer Protection Council coming out in the protection of lenders and suggesting that they also might want to intervene to protect lenders by encouraging or getting consumers to pay. I think it's something that is critical for people to understand that in certain societies and even in the evolution of credit, that giving of credit and loan recovery has been in some ways part of a criminal enterprise in what the mafia does. And I don't know how many of us are familiar, at least by association or by watching movies or reading books about how the mafia operates in America and in certain other countries. Loan recovery is, or loan shacking, better to call it that way, is a central income for criminal organizations, which is why in any country, be it Nigeria or even in the UK, which was the UK is a capital of financial innovation, so to speak, and you probably are aware that the first set of money lenders and digital lenders started in the United Kingdom, and a few of them had quite unorthodox methods of trying to recover money, including naming and shaming people, which was what some of the online lenders were doing, and including sending heavies, strong arm against those people. And so one of the first things you need to do, no matter how pressed you are for credit, is to ensure that you only take money from credible organizations. Check whether those organizations are registered. Be certain that they are within the legal framework of lending money in Nigeria. And that was probably why the FCCPC had to insist that a lot of those people who were the online money lenders, who were outside of the regulatory framework, needed to register. And by the way, you may know that Nigeria is a federal territory, and being a federal territory, it is not only a license of the central bank that you require to be a money lender. Each of the states of the federation can give a money lending license for people to operate as money lenders, which means that it is important. And once you have that money lender's license from any state of the federation, you're going to find out that such a person is able to even do online lending, which is why the FCCPC came into trying to get the more, should I say, unorthodox methods of collecting money out of the system. And so for you as a consumer of credit, you have certain rights. And the starting point should be even before you take credit. Be certain, people have talked about previously about what you need to do, be sure of what you're taking the money for. The first thing I always tell people is, if you are taking money for your business, let it be money that is being taken in the name of that business. That business should not just reside in you. That business should have a legal personality of sorts. It should be a vehicle, it should be an entity that you are going to use to do the business, whether it is a limited liability company or whether it is a registered business or a limited liability partnership. Organize your business in such a way that the business is not just you, and that your personal loans are different from your business loans, so that in the event that things are going sideways, you are able to make a differentiation between your personal assets and the business assets. I think one of the advantages also of you being in a seminar like this and being in touch with credit registry is that you have a team of people who can give you guidance on what you need to do. So for instance, you have a business that, let's say, produces water. It's important you keep it separate from your private finances, and that you have proper compliance and accounting processes, that there is a proper balance sheet for that business, and you do not put your personal expenses on the books of that company or on the books of the entity that you're using to do business. The other thing to note, it's important that as you are conducting your business, that when you are about to take a loan, that you need to look at the fine print of the documentation you are being asked to sign. You need to be certain that the interest rate is within what was discussed. You need to look at the repayment terms, and you need to look at the penalty or default penalty fees. Because a lot of times people complain that it is a 3% interest rate, a 4% interest rate. It is 4% when you are performing and paying monthly. There are default interest rates that kick in when you fail to repay. So it means that you need to look at the fine print and know what it is you're signing up for. You've signed up and you have gotten the money. You're having difficulties repaying. There are processes through which you can approach your lender to ask for an adjustment to be made. In the unlikely event that, in spite of your best efforts, there are defaults and there is a negative report about you, you have to certain rights to look at it. The first thing to do when you see a credit report that is not in tandem with what you believe it is to go to the credit bureau. Come to credit registry if it is issued by the organization and say, these are the issues I have. And let credit registry now be the go-between, between you and the person and the lender and the person who made the report. A lot of times people make the mistake of going to write or threaten litigation. I can assure you it's going to take you a lot longer, because the finance houses are more, do I say, in a superior position in terms of being able to get this done. So approach credit registry. Credit registry will be able to interface with the lender and ensure that your report is corrected and that the proper thing is put in place. In the event that it turns out that the credit is actually outstanding, it will be helpful for you to take immediate steps to try to remedy the situation. You could reach them to say, this is restructured in such a way that while it is not being said you are not owing money anyway, it is no longer in default, so that you can continue to access credit. So by and large, the law protects you from Shylock lenders, but that is when you are dealing with lenders who are within the legal ecosystem. If you go to a Shylock lender who is outside of the legal ecosystem, your ability to enforce your rights will be circumscribed. Additionally, approach, seek information, and do not take the confrontational approach. The best thing to do is to seek to understand how best to modify a report that is wrong. If it is wrong, it will be corrected within 10 working days. If it is not, then there are other means of ensuring that you are back on track. And finally, the way you take money from people, be certain that it is not only banks that can report you to a credit bureau. Even your landlord, if you sign an agreement, can report you to a credit bureau. Any person who extends credit to you, even for services, is by definition of law a credit information provider, and the person can provide your information. And so they've talked about, I've heard someone talk about the fact that people's loans outside of the banking system should be reported so that it is good for you. That is how you also should be conscious that if, for instance, you default, with your landlord. You need the landlord can report to you, and it's the same thing. If you see a report from a landlord that is wrong when you actually are not owing your landlord, come to credit registry. These things can be corrected, and you find a dispute mechanism that goes through it. But again, congratulations to everyone who has joined. You've taken the first right step. There are experts here who do this every day in and out. They will be able to guide you. Even outside of this seminar today, if you have questions, please send an email. There are people who are willing to assist you to ensure that you do the right thing. And to just recap, first of all, get your legal structure right. Ensure that you have a proper entity, that you separate your personal loans and your personal business from your private ones, your business affairs from your personal ones. Ensure that you look at the fine print of any loan agreement or financing agreement that you are looking to sign. And in the event of a dispute, seek the proper process of resolving the issue. Don't hesitate to go to court. Approach people, experts who can help you, and overall, we'll come to a good resolution. So time is fast spent already. Let me not take more of your time. Yeah, there are other people who will speak, and if there are questions, I'm happy to take.
Thank you so much, Mr. Kalu Abotsi, for that wonderful and insightful session. Without further ado, I earlier mentioned that we have a team of experts, credit bureau experts from Credit Registry, take us through the panel session. So I'm going to call on our expert in the house to join the conversation right now. I'll be calling on Ijoma Ibe. Ijoma Ibe is a data analyst with over 7 years experience. She has expertise in data management, product development, and she's very good at business analysis and all that. I will also be calling on Chibuke Anumudu, is a sales support officer, a relationship manager with Credit Registry. Also, I'll be calling on Gbemisola Abraoye. She's a customer success officer from Credit Registry. She has background in financial technology marketing. She has over 12 years experience in the credit bureau space. So she's coming in with a lot of knowledge to provide insightful information to everyone. I also have with me Tolulope Lewis. Tolulope Lewis is a customer success executive with Credit Registry with over 10 years progressive experience in the credit bureau space. So guys, join me on the panel. Let's have this conversation. Let's provide insightful information to our audience. They want to learn why they need a smart score. They want to be a millionaire. They want to know why they need a smart score to be a millionaire. Thank you, guys. I'll start with Ijoma Ibe. I have a question for Ijoma Ibe. I want to be a millionaire. I really want to be a millionaire this year. That's my New Year resolution. Why do I need a smart score? So tell us briefly in 2 minutes, why do I need a smart score to be a millionaire?
Thank you, Tayo, for that wonderful introduction. So now we've heard about a smart score, and what is a smart score in the first question? Smart score is Credit Registry's brand name for credit score. And we've heard Mr. Zenith say something about credit score, how someone was able to buy a land using their credit score and their credit history based on they went to a certain bank to collect a loan to buy a land, and they were able to fulfill all the terms and agreements of that loan to be able to become a landowner. You see some situations where there comes people, small business owners, they approach institutions that they want some form of credit for their businesses, and these credits will be availed to these people, and once they utilize this credit very well, they become millionaires. Now, what is this? Now we've talked about a smart score, saying that a smart score is Credit Registry's brand name for credit score. And what is this credit score? Credit score is nothing but a number that represents an individual's credit worthiness. Now, we want to talk about credit worthiness, and credit worthiness is just credit worthiness is how you have availed yourself in the credit lifestyle, how you have availed yourself to collect a form of credit from one person or 2%, and how you have behaved. And your smart score will also indicate how likely a lender is it's how likely a lender will avail credit to you. And what are these things that will make a lender avail credit to you? The lender will have to look at your credit score. And this credit score, what brought about this credit score? This credit score comes about based off your credit report. And what is in my credit report? Your credit report have details of what you have borrowed, when you borrowed it, and how you have the terms and conditions. This credit report will also show the conditions that yourself and the lender has agreed that this is how I'm going to make my payment, and how you have consistently made this payment. Your credit report is more like a report, your report of your credit lifestyle. Whatever you have done in the credit credit lifestyle, it's going to be there on your credit report. You will see what you have borrowed, when you have borrowed it, how you have been paying, when yourself and the lender has come together to agree that this is how I'm going to pay, how you eventually decided to start paying, whether you decided to run away, it's there. Whether you paid when yourself and the lender agreed that you're going to pay, you are going to see it on your credit reports. So whatever is a transparent report of yourself and your lender, whatever both of you have agreed that whatever I have collected, this is how I'm going to work. This is how we are going to work on this credit together. It's going to show there. You're going to see it there. And with that, your credit report, we have, rather than having all those reports showing all the things that you have done on the credit lifestyle, it comes out as a number, and that number becomes what? Your credit score, which in credit registry we call it your SMART score. So yes, you can be a millionaire with a good SMART score. Thank you.
All right. Thank you so much, Ijoma. You heard it, guys. You can't be a millionaire with a good SMART score. It all hinges on your credit behavior and all that. So Ijoma, briefly, tell me, what is the significance of the credit score stroke the SMART score? We've been talking about SMART score. So educate us. Why is this so important for me to be a millionaire?
Okay, so we cannot overemphasize how you have performed with your credit. I know Mr. Zenith really hammered a lot about this, our credit score, and how we perform using our credit report. Now, we want to talk about the significance of a good SMART score. The significance of a SMART score is that lenders use it to predict your credit character. You can use your SMART score to predict your credit character, and we know, and using this credit score, the higher your credit score, the more likely a lender is to avail you credit. Another significance of the credit score is that you can get access to credit at a competitive interest rate. Once you have a very good SMART score, lenders will be looking for you. It's not you going to approach lenders now, but the fact your SMART score is a good one, you have very good SMART score in the industry, lenders will approach you. I believe one or two people would have seen lenders send us messages, however they have gotten that information to send us that. So once you have a very good SMART score, lenders will approach you. And once lenders start approaching you like this, knowing fully well that you have a very good SMART score, you have an edge to actually negotiate your interest rates. You see what a good SMART score can do to you? It gives you an edge to negotiate your interest rate. Again, going into the corporate world, employers now use your credit score to actually employ you. You see, once you pass maybe you are called for interview. After the interview session, employers will tell you, get your SMART score. We want to see your credit report. We want to see your SMART score. We want to see whether you have a very good character. So your credit report, your SMART score shows the character you have in the credit lifestyle. Another significance of the credit score is that even landlords now use, you see our legal practitioner, Mr. Carlo, has actually mentioned it, that landlords actually use your credit score to predict, to know whether they should go ahead to have you as a tenant, because your credit score gives an insight of your character. However you have behaved with someone, with any kind of credit someone has availed to you, it goes a long way to show someone how responsible you are whenever they are whenever a form of credit is availed to you. Thank you.
All right, thank you so much, Ijoma. Now I understand the significance of a SMART score. I still want to be a millionaire. It's important I get my SMART score to be the millionaire. So that brings me to the question, how do I get the SMART score? How do I get the SMART score? So I'll call on the credit bureau expert in our midst, our sales guru, our sales support officer, Chibuke Anomodu. Tell me, please, how do I get SMART score?
Thank you so much, Temitayo. You don't need to do so much to get access to your SMART score. Just a simple step. So send an email to sales@creditregistry.ng or visit creditconnection.creditregistry.ng to have access to it. I will drop the email and the website on the WhatsApp in the chat box currently.
Okay, thank you so much, Chibuke. Please drop the email address, the website of Credit Registry, all the information so people can have that. You can follow us on our social media pages also to make inquiries on the Credit Registry _ on Instagram, on LinkedIn, on Facebook, on Twitter. We are always available to help you get the SMART score so that you can become a millionaire in 2024. So right now, I'm now turn this over. Okay, he has dropped the link. The link is in the chat room. The link, contact us. You can follow us on our social media pages. Please drop the handles of our social media pages. You can follow us, ask your question. Well, send us messages from the DM. We'll respond to you and give you all the information we require to get the SMART score. Okay, so I'll now turn it over to Bemi Sola Aroye. I want her to provide insights on the information on the credit report, right? We want to know how the information on the credit report influence the SMART score. You know, this will affect if they will give you the credit or not. So how does those information on that credit report affect the SMART score? So Ms. Hola,
thank you, Temitayo. Information on credit report affects you as a person. If you are paying back as a when due, how many times an inquiry has been made on you from different subscribers that you have approached for credit, and how many approvals were made when the submission or the request was made. These affect your credit reports. Aside that, your account status, is it performing? Is it derogatory? So those informations on your credit report affect you as a borrower. In addition to that, the balance. If you are heavily indebted, it will definitely affect your being denied of credit. Then how many years have you built your credit history? These will also impact either positively or negatively on your credit report. If you have been in the credit circle for the past 18 years, you have performed very well, you have of good credit behavior, you will definitely be a hot cake in the credit market. So a lot of subscribers will definitely, they'll be out to, get you to take loan from them. We can compare this to someone that have just started taking credit about 2 years ago. He has not built his credit history. So there won't be much information that the subscribers will rely on to avail you of any credit. So it is very, very crucial for us to build a good credit history. This goes a long way to give us a lot of opportunities to get credit from the different subscribers we have. And information is key. So the information these subscribers get from credit bureau is what they rely on to avail you of credit. And in addition to that, you realize that in the credit reports that is being availed to you, your previous information your recent information, all these are being captured and put together to empower our subscribers to make an informed decision.
So much, Remy. Thank you so much for shedding light on that. Credit information, your credit behavior will help our customers make insightful decisions that will also influence your smart score. So I'll now turn it over to okay. So we're wondering, as businesses, our legal professional mentioned that your landlord can report you, businesses can report you if you are indebted to them, and so on. So as businesses, how do I check the smart score of my customers? Yes, as a business, how do I check the smart score of?
Okay, so if you are an existing partner or subscriber with credit registry, you can easily plug onto our API to access the smart score of your customers. If you are a new subscriber, there are a couple of documentations you need to present to certify that you are a business. And thereafter, we have a data exchange agreement that grants you access to credit registry resources. Alternatively, you can send an email to the same email address I provided in the chat box for further clarifications. Thank you.
Thank you so much, Chibuke. That was straight point. So this is for you again, Chibuke and Umudu. How do I manage my credit score or my smart score? How do I manage it? Can you shed some light on that?
Okay, thank you again. So there are a couple of strategies you can apply, to sort of manage your smart score, and these strategies are to be applied concurrently. You shouldn't apply them in isolation. The first step is pay your loans on time every time. So the higher your proportion of on-time payments, the higher your score. So every time you miss a payment, it negatively impacts your score. And so that's how it works. The second one is to avoid applying for multiple credits or loans in a short period of time, or accessing facilities in a short period of time. So what this shows is that you are facing financial challenges. And if the credits are approved, you will have challenges also making timely repayments. So another factor to this is that for every credit you apply, the lenders run a credit check on you, and these credit checks are funneled into the model as inquiries. So the higher the number of inquiries in a short time you have on your credit report, the lower your score. Another key strategy you also need to manage is to handle your debt load wisely, right? So when you begin to owe a lot of debt across different accounts, multiple accounts, it negatively impacts your smart score. So rather than having a lot of loans in a short period of time, try to stretch it out, space it out. So when you are almost about to complete a particular payment or a loan repayment, you can apply for another one. Then the lengthier you are in the credit system, it raises your credit score, right? Because credit scores are based on your behavior over time, and the more experience your credit report shows that you are of good behavior, the more information there is for lenders to determine or gauge your propensity to pay back loans in time. So do not be afraid to use credit. Rather, take credit responsibly. Even if you do not have a long credit history, you have a short one, you can also have a good score as long as you efficiently apply all other factors, right? And then endeavor to pay off your loans completely. So do not think that that 10 naira balance still remaining with one lender or the other does not mean anything, because that lender might be reporting them as overdue payment, and this will negatively impact your score. So ensure to clear out, even if it's 5 naira or 50 kobo with every lender. And order your credit report. So this is the most important one, because this is the way you know how lenders report to you, and quickly nip things in the bud in terms of where wrong informations are labeled on you in your credit report. So you can quickly engage credit registry or the lender to correct such misinformation. Thank you so much.
Thank you so much, Chibuke. Chibuke have said, order your credit reports now. It is important you know your smart score, to know your credit report. So if you have any problem, any challenge, you correct it immediately. If you still want to be a millionaire this year, order your credit reports, know your smart score so that you prepare yourself appropriately. So I will now turn it over to the dispute guru in the house. She's a customer success executive, Tolulope Lewis. I have 2 questions for you, Tolulope Lewis. So, please quickly tell me, what happens when the information on my credit report is not accurate and is negatively affecting my, smart score, my credit reports, and that information is not accurate? Take me through the process of addressing it. How do I fix it quickly so that it does not affect me anymore? So, Tolu, you have 2 minutes. Over to you now. Thank you.
Thank you, Temita. It is good to be here. So to address this question, the right thing to do is to file a dispute. Filing a dispute will not hurt your smart score directly, but can potentially affect it depending on the outcome of the dispute. So for example, if you're disputing a personal information such as an incorrect name or an address that you've never lived, this has no bearing on your smart score. However, it is very, very important that you have a correct information, a personal information on your report, because it is the first step of integrity when it comes to lender making their decision on your new credit loan. But if you're disputing a late payment that was mistakenly reported on your report and it is corrected, your smart score could be, and it is likely that it will be improved. So how can I dispute a credit report? Inaccuracy of credit reports are relatively rare, but they happen time to time. And that is why it is advised and it is wise to regularly check your credit report, to ensure that any incorrect information on your report is being disputed through credit registry dispute desk or any of the credit bureau reports that you have their report. So if you're able to, and then it is even better to wait until this dispute is resolved before applying for a new loan to avoid being rejected. So, it is so crucial that you check and monitor your credit report that comes with your smart score on a regular basis, so that before you leap to ask for a new credit loan, you know what the lenders know about you, what they are saying about you. And it is a very, very crucial thing when it comes to dispute resolution. So that is my answer. And you can always monitor your credit report using an individual report using our site, the creditconnection.creditregistry.credit.ng. So this gives you leverage of how to monitor and even point you when any change has been made on your credit report. So if it is good or bad, it points you for a quick resolution before this is escalated to your lenders or anybody that's may concern. Thank you, Temitayo.
All right, thank you so much, Tolu. So very, very important. It is important you see yourself from the eyes of the lender. Order your credit reports now for yourself. Make sure that you're prepared. As you're doing your annual medical checkup, do your annual credit checkup. Check yourself. If there are any irregularity, anything, address it quickly, escalate it to the appropriate authorities, get it cleared out so that you can prepare yourself when you need to assess credit, right? So the second question I have for you, Tolulope Lewis, how long does it take to resolve a complaint? For instance, there's a mistake on my address, my name, or there's a debt I've cleared already and it's still showing on my credit report. How long does it take? And in addition, does it usually attract a fee? Am I supposed to pay something? How do I get this rectified? Thank you.
Okay, dispute usually takes within 15 days, depending on the type of issue that type of inaccuracy on the report, and is at no cost. And we advise that after your dispute is being completed, you can go log into your Credit Connection account to see the outcome of the dispute and how it affects your score. So, and another thing I need to say is, what if you disagree with the outcome of your dispute? So, we are just the third party between you and the data provider. So if you dispute any inaccuracy and the data provider comes back to say that the information you're disputing is accurate, we come back to give you this information, and the information, the inaccuracy will remain unchanged, because the owner of the information, that is your lender, is saying that the information we have, or you're seeing on your credit report is accurate. However, if you disagree with the outcome of a dispute, you have up to 3 or 4 options that you can take to ensure that this is being resolved. One is to contact the lender or data provider to provide or seek correction of the discrepancy in their records. 2 is to refile a dispute with the credit bureau, including adding additional evidence of the inaccuracy. 3 is to add a comment of dispute to your credit report until resolution. Then 4, when you've tried all these 3 and a solution is not coming forth, then you can seek a legal redress.
Thank you so much, Tolulope Lewis, for your answer. I'm sure everyone has been able to learn how to manage the dispute resolution process, why they need their SMART score, how to order a credit report and things like that, right? So it's now the Q&A session. If you have questions, please drop your question in the chat room so that I can have our experts in the house answer your question. I can see about 2 questions. Abimbola says, are there any common misconceptions about SMART score that you often encounter, and how would you clarify or debunk them? So I'll be giving this question to Chibuke and Anomudu. The question is, Chibuke, I'm reading again. Are there any common misconceptions about the SMART score that you often encounter, and how do you clarify or debunk them?
Okay, so not that I know of, but what we usually do or how we treat it is that whenever a customer comes with any complaint regarding his or her score, of course, it passes through the dispute channels. So they liaise with the dispute team and then figure out what the issue is in concert with the lender to, sort of resolve it conclusively. Thank you.
All right, Chibuke, thank you so much for that. So I have another question here. This will be for Tolulope Lewis because you are the dispute expert. This Daniel says, how do you file the dispute? What is the process of filing a dispute in the first place? So you can enlighten Daniel on that. So you're muted. You're muted, Tolu.
Yeah, apologies. Just like I said earlier, it is important to monitor your credit reports regularly to ensure its accuracy. So where can you see or view your credit report is by visiting any of the credit bureau or go to our website, creditconnection.creditregistry.ng. So if you spot any issues, your reports, Credit Registry Dispute Desk Center is the quickest and easiest way to lay your complaint for resolution. So first, you can send us an email through our email channel, dispute@creditregistry.ng. Well, once we view your attached your credit report, once we're able to view your credit report to see what actually is wrong with the report, then we will acknowledge your email and then give you an ETA for resolution. So once the resolution is being given, we're going to get back to you and then give you the update on the resolution. So it could be either your report has been rectified, corrected, or it has been updated. So once we give you that, you can go back to the website, your credit connection account, to view the changes and see how it affects your score. But again, the resolution timeline depends on the type of issue that your credit report is having, type of inaccuracy.
Okay, so typically, Tolu, can you tell us what was the timeline from within 5 to 10 days? How many days?
It's within 15 days. It's within 15 working days.
15
within
working
15
days.
working days. Yes.
All right. Thank you so much, Tolu, for that. I cannot see any other question in the chat room. I would like to say thank you to the panelists, our credit bureau experts from Tolu to Ijoma Ibe to Chibuke, to Bemi Araoye, and to Mr. Kalu Abosi from Astor Law Partners. I've learned a lot during the session, and we've learned that our credit score is not just a number. It's like our financial resume, right? This will show you where you are, and it can affect your ability to access credit and also affect your financial goals on the long run, right? So it is important that you order your credit reports now. You don't have to wait till you need credit. See yourself from the eyes of the lender. If you have any doubts, order your credit reports. Go to www.creditregistry.ng. We'll drop the link in the chat room. You can contact us on our social media platform. We are just a DM away. Order your credit reports now. Set out well for this year if you want to be a millionaire. Know where you are and be prepared so that when you apply for credit, you can get it as that's when you need it. Thank you so much for joining us. I'm going to hand over back to Chidima Eze to continue the conversation. Thank you so much.
Wow. Our set of millionaires. Please, can we put in the chat box our emojis? I know we enjoyed this session, so can we just celebrate our panelists? Thank you so much, our credit bureau experts, for that insightful and informative segment. Now we know what to do if we want to be millionaires. We know the importance of our SMART score. We also know the right way to go about disputing any information that we feel is not correct in our credit report. So please make use of the information that has been shared in the chat room. If you want to order your credit report, if you want to know your SMART score, just send an email to the email that has been provided or visit our website, creditconnection.creditregistry.ng. Thank you so much. Let's keep the emojis going. Thank you very much. Now, we also would like to get your feedback. I know that we've gotten value from this webinar. So the link to our post-webinar survey has been dropped in the chat box. Please take a moment to give us feedback. We would like to know about your experience and how you've gotten value. So please do not leave yet without dropping your comments through the post-webinar survey. And then finally, to take our vote on 10 of 10, so we're calling on our Senior Head Corporate Services, Ms. Nkechi Wokoroku, to close out the webinar. Over to you, ma'am.
Thank you very much, Chidima. Thank you, everyone. And on behalf of the Africa Credit Expo team at Credit Registry, my MD CEO, Dr. Jamila Sherif Ayedun, we would like to extend our heartfelt gratitude to the speakers, the panelists, the moderators, our sponsors for making this happen, and to all of you, our attendees, joining us now via our Zoom platform and also our various social media platforms. I want to say thank you very, very much. Mrs. Tosin Ojo, Mr. Zenith, you have illuminated, this virtual workspace with your knowledge, your insights and expertise. Our panelists, a heartfelt thank you to you as well. You have brought to us so much insightful discussions, offering diverse perspective and fostering an environment of intellectual exchange. In closing, we want to ensure that you guys live and retain the knowledge that was shared at this webinar. And we wish you a fantastic rest of the year. May the connections that you made today and may the knowledge that was shared serve as a catalyst for positive change in the credit landscape across the African continent.